Hey, Kyle here with winthehouseyoulove.com. Today we're talking about FHA down payments. We're going to talk through what's required and some tips and tricks as well that people don't know about on FHA loans. So down payments, first of all, why in the world does a lender need a down payment? You need to have a down payment to have basically some skin in the game when you purchase a home. It makes a loan less risky to lenders, meaning they're going to give you better rates and better terms when you close on a deal. They don't want people not having any stake in a house because it's really easy for somebody to just walk away from it. So also, having a down payment is going to help you build equity in a property over time. So with FHA, there's two minimum down payments, and it's going to be dependent on your credit score. So first, if you have a credit score less than 580, then you need to put 10% down as a minimum on your FHA loan. Okay, FHA will actually go all the way down to a 500 credit score. There's not a lot of lenders that will do that, but you can go down that far. If you have a 580 credit score and higher, then your minimum down payment is going to be 3.5%. Something to note with the mortgage insurance that FHA has is if you actually put greater than 10% down, so if you're over in this category, your mortgage insurance is going to drop off after 11 years. So if you put the minimum down or put less than 10% down, then you're going to have mortgage insurance for the entire life of the loan, which is going to be really costly over time. Stick around to the end. I'm going to talk with you about the strategy with FHA loans and where people get FHA loans wrong. Okay, so those are the minimums. There's one weird kind of caveat with FHA, and that's if you're purchasing a HUD REO. So that's a property that's currently owned by HUD. So that means that property was a foreclosure in its previous time. You can actually put a minimum of $100 down on that property. So if there is a HUD real estate owned property that was a foreclosure and HUD says, hey, it qualifies for this program, your down payment is only $100. And it's not a bad program. It's sometimes difficult to find, but that is an option there for you. Also, you have programs like down payment assistance programs. I would not recommend these programs. Down payment assistance programs tend to be more expensive over a period of time, right? There's no such thing as free money. That money is going to come from somewhere. So if you're not paying for it up front, you're going to pay for it over time. And a lot of people don't realize that. Same thing too with, even if you're not paying for it, if it's a grant or whatever, most of the time you're going to be locked into a property and that loan needs to be repaid. So it's something to be cautious of. It can get you trapped into a property and be expensive over a period of time compared to regular loans. So I wouldn't recommend down payment assistance. I think they're really expensive loans, but they're an option for you if you don't want to go with these traditional down payments. But for most people, you're going to be looking at 3.5% down is pretty standard. Most people have a credit score above 580, but if you're between 500 and 580, you do have that choice of 10% down. So where can these down payment funds come from? The two main places would be checking and savings. So you probably have a checking and savings account where you get money from your job. So that money is coming in and you can use that money to then go put down on a home. If you have cash can be a little bit more difficult. A lender wants to see that it makes sense that you have cash on hand. So if you're somebody who uses a bank account often, but you also have $5,000 in cash, an underwriter is not going to let you use that cash to use towards your down payment. And the reason why is because you have a history of using a bank account. And what the lender has to make sure is that that cash isn't being borrowed in any way. And it's impossible to tell with cash. It's impossible to trace. So if you're using cash, you have to have a very special circumstance where you're writing a letter to an underwriter explaining how you've accumulated the cash, how you have a history of accumulating this cash. They're going to look at your expenses. They're going to see at your withdrawals and see, does it make sense? Does this person actually have cash saved up? And can we reasonably believe that that's not borrowed money? Also, you can sell personal property to get money for a down payment. So on a bigger scale, this is a home. So if you're moving from one house to another, you can sell that home and use the equity as a down payment. You could also sell a car or a motorcycle or really any personal belongings to get money for a down payment. Just make sure that you're documenting all of those sales. Don't do them in cash, right? You don't want to sell a boat and then get a bunch of cash and then try to bring that into the deal. It just won't work. Everything needs to be documented in that deal. Okay. FHA does not allow unsecured loans. So you can't do cash advances. You can't do payroll advances. You can't do credit cards or personal loans. Those cannot be used as a down payment. The only type of borrowed money you can use as a down payment is a collateralized loan. A collateralized loan is just a loan that is borrowed against something. So if you took a loan against your 401k, a loan against your IRA, or a loan against property, those are loans that are collateralized, meaning that if you don't pay them back, there's an asset there to recoup that loan. So you can use secured loans like that, but you cannot use unsecured loans. Unsecured loans, again, are things like credit cards, personal loans, any other loan that's not secured by an asset you can't use. Okay, so if you don't have the money there, you could also look for gift funds. And gift funds are money that you get from a donor who's basically saying, hey, we'll give you this money and we don't expect you to pay it back to us. It's just a gift. Here's money for you for your down payment or your closing costs or whatever you need. So here are the sources that FHA allows. They say it can be a borrower's relative. It can be a borrower's employer or labor union, a close friend with a clearly defined and documented interest in the borrower, a charitable organization, and a government agency. This would be something that would be like a down payment assistance program. Okay, so most people get a gift from a relative where they're talking with that relative and saying, hey, we need some money for a down payment. Something to note with these is that the donor actually is allowed to borrow those funds. So if you have, let's say one of your parents is willing to give you a gift. If they take out a loan for, let's say, $5,000 and gift you $5,000, that's actually allowed. But you cannot take out a loan for $5,000 for your down payment. So it's a little strange. And you're also going to have to sign documents saying that the donor does not expect repayment. So something to watch out for. So the donor can borrow funds, but the donation cannot be cash. So there's a couple little just fine lines in there that make it a little tricky to go with gift funds. If you are using gift funds, if you know that you don't have funds available for the down payment and closing costs on your own, talk with your lender to make sure that you're documenting the gift funds correctly. Too often I see people go ahead and move money around with donors, and it makes it a nightmare for us to have to document and trace that money because I've had instances where a donor takes money from an investment account over to a checking account, and then they transfer it to our buyer's checking account, and then they transfer it to their savings account. And what becomes difficult is I now need to document that entire flow of that money. No longer do I just need one statement. I need to see this entire flow because the underwriter wants to know where all these funds are coming from. They can't just see a deposit of $5,000 or $3,000 or whatever your down payment is. They can't just see that deposit and then say, okay, it was from a donor. They have to see that it came from an acceptable source. Okay, now as far as the strategy with FHA, you're going to normally go with an FHA loan. Most people are going to do 3.5% down, right? FHA loans, I like to think of kind of like almost like a short-term bridge type loan, because ultimately what you want to do is you want to refinance into a conventional loan. A conventional loan's better because it removes any mortgage insurance. You're going to get better terms and more cost savings over a long period of time with a conventional loan. But FHA might be good for you now to have the low down payment, and they're easier to qualify for on the FHA side. So what I would suggest is if you're taking an FHA loan, in the next 6 months to 3 years, you need to be building your credit score, making that higher. We want to get that to a 720 plus for a conventional loan. You're going to get really great terms and rates on a conventional loan with your credit score that high. So you're building credit. You're building equity, so you're paying down your current mortgage. You're making improvements if you need to build up the equity in your property. And if you had a bankruptcy, foreclosure, or short sale, we're waiting for that those waiting periods to come off of the seasoning for you to be able to qualify for a conventional loan. So FHA loans are great to have now, but then we want to work on an exit strategy to refinance into a cheaper loan. So it's something to be mindful of. Also, when you're setting up the FHA loan, you want to keep in mind what costs you're paying. Because not only do you have your down payment, but you have closing costs on top of it. No matter what lender you're working with, you're going to have to pay closing costs, things like title, recording fees and appraisal, insurance, taxes, credit report fees, different things like that. So what I recommend with FHA loans is, since they are temporary loans, right? At least in my mind, I don't want you to have an FHA loan for years. I want you to have an FHA loan for as long as it takes for you to be able to refinance into a conventional loan. So what I always recommend is looking at getting a credit from the lender towards closing costs. So what happens is you raise your interest rate to receive a credit towards your closing costs. So let's run through an example. Let's say you talked with a lender and they said, hey, we could give you a 3.5% rate on an FHA loan and it would cost $0 in points. So no points, no credit at all. But that sounds like a good idea. Like, we have a low interest rate, but if our plan is to refinance that loan anyway, why not get free money to pay off our closing costs, right? Because we might have $0 in credit, but we have an additional $3,000 in closing costs that we have to pay out of pocket. So instead, what if we took a higher rate? Let's say we bumped our interest rate to 5%. And we received a $3,000 credit so that our cash at closing for closing costs was $0 and all we had to bring was our down payment. So we took a higher rate to basically get a credit of money back to pay off all of those closing costs. And then what happens is we refinance over into a conventional loan. If I can spell conventional. So, it's not always about the rate. It's about the longer term strategy that you're in. There's no point if right now you have a credit score that's 600 and you're getting an FHA loan, there's no point in trying to get that aggressively as low as possible on your interest rate. But I see people do this all the time because we're always told it's always about the interest rate, but it's not. It's about the long-term plan that you have. So if you're paying all this money to lower your interest rate, but then you're going to refinance into a conventional loan anyway, or worse yet, you think you're just going to hold on to this loan for 5, 10 plus years, then you're going to waste a lot of money. It's always better with an FHA loan. Let's increase the rate. You're only going to be paying that for a few months, maybe a year or two. Higher rate, pay those closing costs off with a credit, then refinance into a conventional loan when you've built up your credit score, you've built up equity, and you're waiting for anything else on your credit report to be fixed. Okay, if you want to learn more about increasing the equity of your property, I have a video right over here. It's going to help you understand how to increase the equity in your home so you can refinance into a conventional loan, or you can get a bigger paycheck when you sell.